Welcome, everyone, and thanks for joining us for the Sky Ecosystem Q1 2026 Quarterly Insights Call. I'm Rune, the co-founder of the Sky Ecosystem and director of the Sky Frontier Foundation. And I'm joined today by Vance Spencer, co-founder of Framework Ventures, one of the most active investors in the Sky Ecosystem and a close partner in the Sky Agent Network with OBEX. So here's the plan for today. I'll walk through the key results from Q1. We'll talk about the launch of the new Sky Protocol financial dashboard. And then Vance and I will go through a Q&A and answer popular questions. We've collected a bunch of questions in advance from ecosystem participants, and then we'll go through as many as we have time for. So let's get into it. All right, so here are the key takeaways for Sky Ecosystem in Q1. Sky Protocol had a record-breaking quarter on its financials. It had its largest ever protocol revenue and protocol surplus in a quarter. And USDS has become the third largest stablecoin and also the largest yield-generating stablecoin in the world, reaching $12 billion in total stablecoin supply at its peak in Q1. What we in the Sky Frontier Foundation are hearing from the various Sky agents that are working to grow the ecosystem and are really in tune with the market is that the really big driver of the success of USDS adoption in this last quarter comes from the Sky savings rates position as a low risk source of reliable value and yield, which ultimately comes from the Sky Protocol. And then the fact that the Sky Protocol and Sky Protocol governance has a relentless focus on mitigating risk and protecting users' funds above all. And this is, I would say, the new vibe in DeFi and in the blockchain industry, that the very large participants with large amounts of capital are primarily interested in risk-adjusted returns and serious risk management. So we've really entered a new era, and Sky is very well positioned for this, as we can see from the results this quarter. So another two major things to note is that happened in Q1 is, first of all, that the Sky Agent network has seen significant expansion. A major reason for that is actually OBEX, which is this incubation project that runs on Sky, and it has launched its first agent cohort that is onboarding a wide range of new sources of collateral to be available to the Sky Agent network to tap into. And this includes things like mortgage loans through the public company Better, and GPU financing through USD AI, and a lot of other super innovative stuff that is perfectly positioned for Sky Protocol and its technology to tap into and really maximize the efficiency and the risk-adjusted returns from. Then the second really major development is that Sky Protocol governance made the deliberate decision to put a greater focus on capital retention rather than capital distribution at the end of this quarter, due to the general trends in the global economy and in the crypto industry. And while the protocol has historically bought back around $100 million in Sky last year and distributed most of it to Sky stakers, so a very significant flow of value, the new focus of Sky governance is to ensure that a lot of that capital is also retained inside the protocol in order to continuously build a stronger capital reserve, and through this basically compound the advantage that Sky already has that I was mentioning earlier, which is that all the major ecosystem participants at this point are viewing Sky as the low risk option that is the place to go, even if there is ups and downs in the economy or in the crypto industry. Basically, Sky is well positioned and continues to be well positioned in this regard to really be the place where all of that capital goes. Right now, the target is to rapidly grow the capital reserves until the target number of 150 million is reached. And overall, as I mentioned, the really big driver of the success of Sky really reaches back to its history. Sky, formerly known as MakerDAO, is really one of the oldest DeFi protocols. It has a completely unsurpassed track record of building and improving its stablecoin protocol for more than 8 years, and it's gone through so many market cycles. Every time it's come out stronger, and it's never suffered any kind of serious setback or any loss to stablecoin holders, or even anything close to that, which is how the reputation and the track record has been built up over time. And this is really just what the protocol continues to focus on in order to continue to compound this advantage. In general, it appears that Sky Protocol, after the major launch and the growth that was been seeing last year, and then the even more significant growth that's occurring in the first quarter of this year, and that's continuing over the course of the year. This is due to the protocol reaching an inflection point where it has sort of reached this fundamentally stronger position based on being highly stable, highly trusted, and with a very strong reputation that helps it really stand out amongst its users. So we're very much looking forward to see how this continues to develop throughout 2026 as stablecoin holders continue to seek better ways to get risk-adjusted returns and become more aware of risk management and how the different options available in crypto kind of pair off against each other, and especially how Sky really tends to stand out when you look at the entire space. All right, so with that, let's jump to the numbers and look at the headline numbers and the forecast model. So in Q1, Sky Protocol managed to beat the expected forecast results on every single metric, which is of course fantastic. And you can actually see that on this chart, there are both the base projection from the original forecast released by the Sky Frontier Foundation at the beginning of the year, and then the actual data, so the actual historical data that was collected at the end of Q1. The really standout number is net protocol surplus. So there, a result of 46 million was hit for the quarter, versus an expected result of just 25 million. So that's a 79.8% outperformance, which is really good. This is really the most important result for the protocol in general. So this is a really good result to get. And net protocol revenue is similarly impressive. So that hit more than 60 million against a projection of around 32 million. So that's another major outperformance of more than 78%. Then on the gross protocol revenue metric, the actual number was 123 million against a projected number of 110 million. So that's also a very decent outperformance compared to what was projected of more than 12%. Then finally, we have the USDS total supply metric, which came in almost exactly as projected at 11.7 billion against the projection of 11.5 billion. So this one was just hit exactly as projected. Overall, obviously, this is actually a really, really great result. This is a great way to start the year, I think. Yeah. All right. Let's look at the revenue numbers in more detail. So here we have the entire 1 year look back of revenue, actually like 4 historical quarters, and then this quarter that just ended. And first, if you look at the line, which is the net protocol revenue, so the dark blue line, you can actually see that it starts off in Q1 last year and in the negative. And then it has basically a steady growth until it hits the extremely good result at 60 million this year. And then if you look at the gross protocol revenue, it's basically for the entire last year stayed in the range of 78 million to 96 million. And then in the beginning of this year, immediately had a massive outperformance, jumping all the way to the 123 million. Yeah, I mean, the protocol has been performing really well last year, and then this year it's really starting to break out. All right, let's look at expenses. So here we have a breakdown of the quarterly expenses for this quarter, and let me just go through them one by one. So the really big one is the Sky savings rate, which is paid to the holders of the SUSDS token, right? And this is really the primary product and value proposition of Sky. It is this very trusted, widely adopted, number one in the world yield generating stablecoin that it ultimately is able to generate a value flow to its holders by tapping into the surplus generated by the Sky protocol. And this is then reflected through these expenses, right? So this is essentially the cost of maintaining this world-class product that is literally the number one in the world. And then if you look at the other expenses, you have the integration expenses, which are at 7.57 million, or 12% of total expenses. And this is a smaller portion, which essentially mirrors the capital cost of basically distributing the decentralized stablecoin USDS to various integration partners. But generally, this expense category is expected to go down over time, as it is really about bootstrapping and kind of getting a foothold with adoption, and then essentially transitioning the primary value flows from the protocol towards the SSR, which is the standard product that Sky provides. Then there's a couple of other expenses, including staking rewards. What's noted here is operating expenses, the DAI savings rate, which is basically expenses related to the DAI legacy decentralized stablecoin, which is the old product of Sky, and then also the Sky token rewards, which was this promotional product that gave USDS holders access to Sky tokens. So these are all very small scale. Some of it is like legacy expenses that over time is essentially going to zero. So what you really end up with primarily are costs related to maintaining the Sky savings rate and then operating expenses of the protocol. And then one thing I should mention here is that if you look at the operating expenses category, it is actually understated quite a bit, because it's showing operating expenses of what was actually spent, while there's also this second category of related expenses, which are not shown on this chart, because it relates to just buffers building up. And so the total amount, including the buffers, is at 14.69 million at the end of this year. But this is actually expenses that are then later expected to be spent. But because it's not counted, since it's unspent, it's sitting in a buffer, then it doesn't show up in the current way that the expense metric is tracked, which is why I'm calling it out here. But overall, if you look at this in general and you compare it to the numbers of the gross revenue and basically the general financials of the protocol, it's in very good health. The expense structure is exactly as it should be, with the vast majority of the expenses coming from the flagship product. And generally, the protocol is becoming increasingly efficient at operating and funding its continued growth and development. All right, so here we have overview of basically the entire collateral portfolio that backs the entire ecosystem, and how it breaks down between basically the Sky agents and the protocol's internal exposure through features such as the PSM. And basically, the really big thing to note here is how Sky is in the middle of this transformation that is now resulting in a major payoff to its efficiency and its growth capabilities. That is the launch of the Sky Agent Network, right? So as mentioned earlier, you have crucial actors like OBEX, and also just the really big, well-known Sky agents like Spark and Grove, that are really the engine of growth and capital allocation and efficiency for the Sky ecosystem. If you look at the beginning of last year, then it was a relatively small portion of the collateral portfolio that was deployed through the Sky Agent Network at only around 600 million. But then in the last quarter, this grew to almost 7 billion. And the rate of restructuring this capital into being under the control of the Sky agents, and then Sky having this better credit-enhanced indirect exposure through its relationship with the Sky agents, is continuously accelerating, and it is really the the secret to the ability of Sky to continuously grow, to continuously remain well capitalized, and keep its users secure. So, for some other key metrics, in particularly related to the key product of Sky, which is USDS stablecoin and the Sky savings rate decentralized yield generating product. As you can see, all of these numbers are generally trending in the right direction, right? USDS supply has been going up generally from almost 8 billion at the beginning of last year to almost 12 billion at the beginning of this year. The number of unique holders has also been steadily growing, with a huge influx in the beginning of this quarter. And then the Sky savings rate generally has been fluctuating. And then as the sort of general financial markets have been changing, and you have seen a general decrease in rates, the Sky savings rate has also been following that as it optimizes outperforming and sort of being extremely solid on risk management. And as a result, it has to kind of follow the general trend of the market in order to maintain that desirable risk profile. And the TVL of the protocol has also been increasing nicely, with more and more assets being entrusted into the protocol because of its significant track record. All right, then we have one of the most important statistics, which is the SUSDS deposits from Q1 last year to now. And as you can see, initially they started at around 3 billion, then they were actually trending down a bit, and then they started trending up massively again. And there's kind of a hidden story to this, which is that at the beginning of the year, the Sky savings rate was incredibly high. Sorry, at the beginning of last year. So a year ago, the Sky savings rate was sort of way above the market rate. It was very, very high. It was subsidized. This is also why there was actually a negative net surplus at the beginning of last year. So as that incredibly high rate started to come down over the course of the year, and the protocol became sustainable, and net protocol surplus became positive and started to grow. Initially, there was a fall off in users who basically left because the rate wasn't as off market any longer. But then Sky found a new product market fit, I guess you could say, or like a new target market to really tap into, which was actually this new type of user that is generally more institutional, more sophisticated, and is aware of things like risk management and the concept of risk-adjusted return, and basically starting to treat DeFi and the crypto industry as something that is more than just a big casino. And this type of user, they're very, very happy with a very well risk managed, carefully governed stablecoin that doesn't just go for super high yields, but instead is focusing on a solid product that you can really entrust with your money for the long term. And then once that user base really started to dig in, you just see this like very, very solid continuous growth. And as I said earlier, right, this is the story generally that in the Sky Frontier Foundation, we're hearing from everybody that's working with adopting users into the ecosystem, that the thing that really is bringing users to Sky specifically is the risk, like the reputation of the risk, and the fact that you can actually look into the numbers. You can actually check what's backing it. You can check every single Sky agent in the Sky agent network, and you can see how their due diligence processes and their risk management is continuously improving. So this is making SUSDS a very popular product, which we of course hope will just continue to grow like this. All right, here we go. So before we go to the Q&A and start digging into all the questions, I will just share one final thing, which is quite interesting and long asked for product that the Sky Frontier Foundation and Block Analytica has been building in order to better showcase the financials of Sky. So what we were basically hearing consistently from institutional participants, from this new class of risk-aware DeFi users and SUSDS users, and just generally from the community, is a more legible and easily understood way to access all of the transparency and all of the data of the protocol. So there's already been a lot of quarterly reports and quarterly snapshots, but to add to that, basically, Sky Frontier Foundation has been building something that can provide the same level of familiar data and familiar descriptions, but with real-time data that is streamed directly from the protocol and all of the data infrastructure that monitors the risk in the system. It has recently been launched, and you can access it at financial.skyeco.com. And what we're showing here is actually the live on-chain dashboard that is pulling the data directly from the blockchain and directly from the data infrastructure. It gives every single ecosystem participant, regardless of if it's somebody who is holding the Sky token and is participating in governance, or if it's an institutional user that's looking into using SUSDS, or even somebody looking at Sky agents or considering allocating capital with Sky. Through this dashboard, they will have a very insightful and direct view into the current live state of the ecosystem, and really be able to look at things like liquidity, capacity for asset deployment, and the historical data like the quarterly P&L, monthly P&L, balance sheet. It's all directly from this, available directly in this dashboard. And all of the numbers we've been going through today, they can all be verified through this dashboard as well. So this is our very first attempt at showing what institutional grade transparency should look like for a DeFi protocol. And like I said, it's live right now, and you can go and check it out at financial.skyeco.com. All right, that was a nice 25 minutes. So I'll hand it over to Vance and let you kick off the Q&A.
Yeah, amazing job, Rune. And yeah, before we get into the Q&A, I just want to say so proud of the Sky team, the Sky Frontier Foundation, for all the growth, all the risk-adjusted return, but also just leading the industry in transparency and institutionalization. There is no other website like that in crypto to go off and see exactly what's happening. So super proud to be an investor and an active participant in the network. We've been casting about for good questions from the community. We really do want to have people ask whatever's on their minds. And with that, maybe we can kick things off. So RWA valuations and private credit and things like that have been in the news for NAVs and how things are marked. But given the widely discussed publicized disconnects in private credit valuations, many believe those to be overstated. How does Sky approach RWA valuations beyond what NAV is provided by the issuer?
Yeah, so I mean, this is essentially the central question, right? To how is the risk of the collateral portfolio managed? And I think actually just the very high level, that's the most important thing, is that Sky has a very long track record throughout almost a decade of operation. There's never been a smart contract exploit or any of these typical issues you see in DeFi. In that regard, Sky is really at a different level on the technical side. It's also the only stablecoin that has an S&P rating. So Sky actually has a real credit rating from TradFi, which I think is also just, it's important to keep that in mind, that the attitude of Sky towards risk and towards operating at a higher standard than the rest of the crypto industry really cannot be overstated. When we talk about risk and we talk about private credit and RWA risk, our baseline is that the risk is the most important thing, and it's sort of the entire job is to really manage the risk, right? So one of the things that's really important is the transparency. So we were just showing the financial dashboard, but there's also lots of other dashboards. There's a lot of ecosystem participants, governance participants that use their Sky tokens to vote, that basically are continuously monitoring all the different data sources, transparency dashboards, and are able to really tell exactly the composition of the protocol in real time. And overall, right now, there is a lot of RWA exposure, but the vast majority of it is in stuff like T-bills or stablecoins backed by T-bills. And then there's a little bit of like slightly more risky stuff But the thing that is so important to understand about Sky is when USDS stablecoins are deployed into assets like, for instance, CLOs or private credit, then it is not something Sky is doing directly. It's done by the Sky agents. And this is what makes it possible, because the Sky agents themselves also put up their own capital. In fact, OPEX, right, which is the Sky agent that Framework Ventures is participating in, they similarly put up their own private capital as to take first loss, including some capital that was actually originally contributed by Framework itself. And so this means that obviously when a Sky agent like OPEX or Spark or Grove, when they are out and they deploy into high quality CLO token like JAAA, they are first and foremost putting their own assets on the line. So they are being very careful with how they deploy their assets, in addition to all of the risk requirements and all the analysis and assessments that are done from Sky's side by the various risk professionals and risk teams that have been engaged with this for almost a decade in Sky. And then finally, the way it sort of all balances out is that because the Sky agents, they have to put up the first risk capital to sort of absorb the risk of the assets they deploy into when they deploy into RWAs that aren't just T-bills. Then essentially how the whole framework works is it's based on sort of the way banking works, based on the Basel framework, which basically says that if you want to deploy into something that has more risk, you have to measure the risk, and then you have to put up more capital than what is represented by the risk you're deploying into. So basically, you have to zero out the risk and ensure that the sort of the super senior position, which is held by Sky and the USDS holders, is ultimately kept at this level of completely insulated from these assets that are deployed into, with the Sky agents having enough capital available to take all of the expected losses. And this is all based on, like I said, on the Basel framework, on just like, the long track record of TradFi to generally being able to, when things are done correctly and due diligence is done correctly and participants don't get greedy, then generally the financial system has been able to run this pretty well for the last several hundred years. And it is those traditional models primarily that Sky taps into in order to provide solid risk management. So there's no like voodoo or like some experimental stuff going on here. It's actually all just like traditional proven knowledge, right, from the banking industry, from the financial markets, and from professionals coming from traditional finance. And actually recently Jan Delagos joined us in the Sky Frontier Foundation as the new head of risk, specifically to take what's already there and then bring it to another level of making it, really sort of tying it together with all of the institutional grade methodologies that are used in traditional finance, and ensuring that basically on every metric, Sky outperforms what's already there and then builds on top of it to get us to something that's even better, but still fundamentally rooted in the traditional approach.
And the only thing I would add to that is the track record of Sky extends, through this quarter, in which there was the somewhat tragic incident with Aave and the Kelp DAO incident. Sky walked away from that unscathed completely, and that is just another piece of data in terms of its track record. And then the OBEX process of incubating these new credit instruments is another really powerful function for Sky to have, just in the sense that as Sky sorts out how to interact with the regulated financial world, a lot of the shortcomings of traditional financial products are becoming apparent. How they're wrapped, what the legal claims actually are, the ability for issuers to put in or take out pieces of credit that you assumed were there. Sky, over the long term, I would assume, is just going to have a very robust end-to-end credit origination flow, which involves going directly to the source, packaging up things in a risk-adjusted way, and then passing them back to the ecosystem in a way that really makes sense and is as high quality as you would expect from the other collateral that is in the system currently. The other thing that is top of mind, especially this week, is the Clarity Act. It looks like it is going to pass on Polymarket. It's at 70-80%. It looks like Coinbase is supporting it. Obviously, this is a US-specific piece of legislation, but in a general sense, what effect would the Clarity Act have on USDS if yield on stablecoins were restricted banned or curtailed. And then I think, just couching this in the sense that USDS is only available outside the US today. And, this is a US piece of legislation.
Yeah. So when you have regulation like the Clarity Act, it fundamentally applies to centralized stablecoins, right? So this is when you have, I guess, pretty much any politician or regulator right now referring to stablecoins, they're talking about these tokens that are issued by companies like Tether or Circle. I guess fundamentally because this is what the system is currently capable of understanding, because those types of stablecoins actually follow a pretty straightforward mechanism, right? Which is you have somebody saying, trust me, I'm going to keep your money safe. And then they're issuing a token. And ultimately, you have to rely on that company to actually honor that promise. And that's where right away the Sky protocol and USDS totally diverges from that, right? It's a fully decentralized piece of blockchain infrastructure. It's fundamentally permissionless in the sense that it's a piece of technology that you can access, kind of like the internet protocols and all of this kind of stuff, right? And when you have legislation that regulates financial products, including things like centralized stablecoins and just like the concept of a stablecoin, they're fundamentally focusing on a relationship between legal entities, right? So this question is really, how is this, if they ban yield, right, that means they're banning accessing yield in a certain form. But the thing about what Sky offers and what SUSDS and the Sky savings rate fundamentally is that it is just a fundamental focus on the best possible risk-adjusted return. And the question of then, like, how do you then access that as a user, as a retail user, as an institution, and so on? I mean, because it's a piece of open and permissionless technology, there's actually many different answers to that question. So unlike a centralized stablecoin where the way you access it really is the product because it's a promise from some issuer. In this case, SUSDS and the Sky savings rate is more like a piece of infrastructure backend that provides highly reliable and risk-adjusted yield flows that can then be packaged in various forms through layers, legal structures, regulated front ends, compliant solutions, and all of this stuff, right? And I actually think that no matter what happens with stuff like the Clarity Act, there will always be ways to access highly efficient risk-adjusted returns. And the reason for that is this is what the market wants, right? And this is what capital wants. Capital wants efficient returns, and it will find a way to do so in a compliant way. And whether that is in America with Wall Street, who has, I don't know how many years of experience finding out how to do compliant finance that is highly efficient, but also anywhere else in the world, it's going to be the same story, right? That the markets, they will want to access stablecoins, decentralized stablecoins, and yield generating stablecoins and the benefits that they provide. And they will have to comply with regulation to do so, but they will also find ways to ensure that they tap into as much of this benefit as possible. And should you have markets that fail to do this, then the consequence will be they will literally fall behind, right? They will lose the ability to compete. And I think this is actually also, if you look at the way this regulation is being approached, I think you can kind of see that there is this understanding that it is a priority to ensure competitiveness in financial innovation and in just general ability to support technological innovation.
Yep, and I think we're both super excited for the legitimization of the stablecoin space via a bill like this, and applaud the efforts by legislators to actually pass this. So let's definitely get this passed. So the next question is actually the most requested topic by a wide margin. Maybe just to tee this up, Rune put forward a forum post, I believe it was 2 or 3 weeks ago, codifying exactly how the net surplus, which is effectively the net profits of the protocol, will be spent on a go-forward basis. It is a hugely transformational post because it actually has just the steady state of what happens with the economics of the protocol encoded within it. At the beginning of the year, about $300,000 per day was being bought back by the protocol. And this ran until, I believe, mid to late March, at which point, the war in Iran, the DeFi credit events, all of the above started to really kind of hit the industry one after the other. And you made and the community voted on the decision to reduce the buybacks and actually pass go forward profits into the buffer for a few months. People are obviously excited about buybacks. They're also excited about building up the surplus buffer for bad credit events, but people are really excited about the buybacks. And so the community wants to understand the full picture. When will the buybacks come back? In terms of this few months that it's been turned off, and now it's going to come back on. And then with the new kind of steady state of the protocols codified net surplus usage, when will that be full in terms of the 150 million target? And then when will the kind of full steady state go from there?
Yeah. So actually, first, one thing to point out is that there is actually still some amount of buybacks happening. I think it's around 5% of the net surplus, but because Sky's making so much net surplus, that's actually still like a decent amount of Sky tokens that are being bought back. But the current setup of the protocol in return in regards to distribution of capital and buybacks is basically that there was this original buffer of Sky tokens that was actually donated to the protocol from the Sky Frontier Foundation at the end of last year. And that is currently being tapped into in order to enable the protocol to continue to provide staking rewards for Sky token holders that stake, but at the same time retain the majority of the capital coming in from the activity of the protocol and from the fees paid by the Sky Agent network. Then the governance approved plan for how to proceed from here is to continue keeping buybacks at this relatively low rate while staking rewards remain high, and the staking rewards are continuously adjusted month after month based on basically the results from the preceding month. So based on these adjustments, I just tried to get this estimate earlier. So my estimate is that it will probably take around 2.5 months or so until the conditions specified in the Atlas, so the governance rule set of Sky, are met, at which point this pre-approved, governance-approved plan is triggered. That then results in, first of all, the rate of buybacks will increase to about a bit more than 25% of net surplus, and then a new feature, or rather an old feature, will come back, which is USDS staking rewards. So when you're staking your Sky tokens, you'll also be able to get USDS rewards. And all the Sky token rewards will come from this from the new buybacks. So there will no longer be this sort of this kind of countdown of like how long can the rewards remain in place. Instead, they will be replaced by this new steady state system that ultimately shouldn't actually reduce the yield experienced by any stakers. The main difference is that a larger amount of the net surplus every month will go towards buybacks that are then distributed as staking rewards or directly as USDS staking rewards. And the capital retention percentage will be at 50% instead of being almost all of the capital coming into the protocol right now. And then the last thing to note is also, for the first time in a very long time, this proposal included actually an approval of beginning token burn from buybacks. And this is kind of an old feature. This was the original MKR token was very famous for, that it had buybacks that were then burned. And this will be brought back with around 5% of the protocol's net surplus being burned, like being used to buy and then burn Sky tokens every month, which is completely irreversible, right? So this will result in the Sky token circulating and total supply continuously decreasing as long as the protocol continues to make more and more net surplus every month. So as I said, about 50% of the protocol's net surplus is still going to be retained as a capital buffer. So even when the protocol moves into this less extreme state where almost all the capital is being retained, and instead it goes towards a more sustainable steady state, it's still half of all of the protocol's total net surplus that's retained in order to build up the capital reserves, which is going to be really important. It's going to really help create confidence for the users. It shows this long-term commitment to security and risk management as a primary priority, right? That there is this very significant cut of all the capital coming in that is going towards building of the buffer. But it is also still a temporary state that is set at this quite high fraction of 50% until the long-term goal of $150 million in the total capital reserves is met. So when that exactly is met, that's hard to predict, because that really depends on how the protocol's results actually play out. But I would say probably 1 to 2 years is how long this will take. And if we're lucky, it will be shorter if the kind of the exponential growth of the protocol really picks up. But then what's really important is once this target is hit, which eventually will be hit, because such a big percentage of the net surplus is going towards building of the capital buffer. And then once the 150 million target is hit, the protocol will then switch to a dynamic target where it will try to maintain 1.5% of basically a capital buffer of 1.5% of the total outstanding supply of USDS in circulation. And then the amount of capital that is retained and put into this buffer depends on how far away the protocol is from the target. So even in very severe scenarios where the target is very high, let's say even if the target was like 500 million, the amount of capital that would be retained would actually still not be as high as it is now. So this is this sort of short-term bootstrap phase where the capital retention rate is really the highest it will ever be. And from here, it's only going to go down over time.
And from our perspective, framework speaking, it's become very clear to us that Sky is going to be, hopefully at least, the consolidating force within the stablecoin landscape in crypto. It's going to grow. It's going to be an incredible business. But as with all of things in the financial world, safety first. Like, you do need an adequate surplus buffer to get to where you need to go. And so while we think of the buyback as starting to come back in, I guess, 2.5 months and scaling from there, it really is important to do things from a defensive perspective, especially when you have things like the Iran war and all the crazy macro stuff that's happening today going down. So look, everyone loves a buyback, but I actually do take a lot of solace that the capital buffer is building back up, and that's a great thing as well. Just a related question, and you addressed some of this as well, which is, why are the Sky yields down? How do you build confidence in spending when yields fluctuate? When people, at least historically, have thought about the expenses within the Sky ecosystem as more of a black box. The transparency that's been demonstrated with the website and the new codified expense framework really helps that. But maybe giving a little color on that would also be helpful.
Yeah, I think the most important thing to call out right away is the very low Sky staking rewards that are being experienced right now by the Sky stakers. It's as low as 1.5% or maybe even less than that right now. And so this happens actually for a very specific reason, which is that basically the number one goal is that the staking rewards should be based on the results that the protocol is actually producing, and not some kind of arbitrary governance set rate. And as a result, it was set based on the actual realized result of the preceding month. But because of basically, I guess you could say, accounting quirks, in months when you have significant growth in the SUSTS supply and that are basically not matched by an equivalent amount of deployment by Sky agents into particular collateral that the Sky agents, opportunities that they have available to them right at that instant, then what's going to happen is all of that capital inflow is going to accumulate in the PSM, which is a way for Sky to basically get a yield on USDC through its allocation network. And the quirk is that the yield that is paid out from the PSM happens, like the yield for a given month is paid out at the beginning of the following month. But the way that the Sky staking rewards are calculated are entirely based on the results of that prior month. So when you see the Sky staking rewards going really low at like 1%, 1.5%, then that's actually the result of a lot of growth in the protocol in the earlier month, and then a kind of deferred profit, you could say, right, where the SUSDS expense is paid up front, but the yield income on the other side is actually deferred until the following month. So they actually, in the recent settlement, which I believe has already gone through, or at least it's currently planned, it's going to be increased again. And I think it will equilibrate to around something like 4 to 5%. And this is generally what I think, given current levels of net protocol income and the price of the Sky token, I would expect something like 4 to 5% to be a realistic range for the Sky staking rewards, which actually is also just, I mean, I remember hearing people mention these kind of numbers being what they thought was realistic, and these earlier numbers that were seen in the past of like 10%, 15% staking rewards. Fundamentally, it's just not something that you can really sustain, because as we experienced, right, there's going to be a lot of inflows in capital to chase that yield, and the price went up as well. And this all helps kind of equilibrate the whole system.
The other thing I would say on this is that these are not inflationary rewards. Anybody can print new tokens. That's generally how staking has operated within crypto. These are either bought back tokens or USDS, actually pure profits from the protocol. So it's an entirely different thing. It's more akin to like a dividend yield that is paid from a stock. And obviously Sky is a decentralized protocol, but that is the closest analogy here. So just one thought from me. Another one that we have is just for people who come from TradFi, who don't really engage with DeFi and all of the ups and downs and the roller coaster. How would you describe Sky's business model in its simplest possible terms? Maybe I can take this one. I think the closest analogy here is a net interest margin business akin to Circle, where people deposit into the protocol. The protocol is ossified. It distributes capital to the agents that rent it at the SSR plus the spread, which is 30 basis points, and the SSR is about 365 right now. And that's what they earn on capital from agents. There's also a variety of capital that is not earning any yield, and that is earning 4, 5, 6%, as it does not have any interest pass back. And so what you kind of generally see with Sky is you have 30 to 40% margins on this stablecoin business. And there are analogies within fintech, maybe not anything perfect, but I do think that is why something like the dividend yield and the pass back and the buyback of tokens is so important, is because this is the ultimate prove it market now. People have kind of come and gone from crypto over the years, and what's happened now is that there's finally reliable revenue generating at scale, profit generating at scale businesses like stablecoins, and there's not a ton of them. There's generally, the stablecoin sector, which has those types of dynamics, and then there's the derivative sector, and that's about it. That is kind of the entirety of the real business type protocols within crypto. And so the best way to think about this is just looking at something like the financial ecosystem insights and looking at the growth, looking at the revenue, looking at the margins, and really the proof is in the pudding for these types of things. So it's a high growth fintech with high margins and a defensible revenue base, because the actual product they produce is a stable coin, which has network effects of liquidity. So that's at least why we hold it. And, it doesn't fail to dawn on me that the protocol has gone from 4 or 5 billion. I think when we first built a position and the stable coin was primarily DAI, to about 12 billion of USDS. And so the growth ultimately is really kind of the guiding factor of the scaling law for all stable coins is, what is the yield? What is the business model? What is the risk you're taking to generate it? So moving to kind of a little bit more on the protocol growth and the revenue side, Sky, and as long as we've traded it, it has been, for better or for worse, completely uncorrelated to crypto markets. The revenue and the earnings, I would say, are ahead of where most other protocols are, and yet that isn't always recognized within the token price. And you can see it even on today. Info.sky.money, I think it's trading at a 13x PE. The stock market, for people who follow that, is like 24, 25x, and it'll fluctuate up and down. But how does the team think about that disconnect? What does it take for it to close? I have my own thoughts, but would love to hear yours.
Yeah, I mean, this has definitely been a sort of major theme of everybody who's been looking at Sky has been noticing. And in some case, there's even been this sort of this question of like, why, can it really be true? Is it too good to be true? But the reality is that the crypto industry has it's kind of going through a phase change where it's like learning that actually pump and dump and crypto coins and Doge coins and that kind of stuff it's kind of running out of steam. And I do actually think that what we're seeing, what we've seen here in Q1 is the beginning of things like what's called, they call it the revenue meta, which I think is hilarious, right? This idea that
yes.
It's time to, it's like time to look at the results, at like the actual capabilities, the actual value being produced by crypto products. And buy the tokens of the ones that are producing really good results, right? I mean, I think the Sky price recently has been doing better, and I think that's probably connected to this. The other thing is also just because, I mean, if you're making a whole bunch of net surplus into your protocol, you can do interesting stuff like buybacks and distributing to stakers, right? And that's another thing that sort of helps in simply just like directly impacting the market price and making it impossible for it to be totally mispriced. Ultimately, from my perspective, it's really in the Sky Frontier Foundation, and I think in most of the ecosystem, everyone is playing the long game, right? The thing that is really exciting and that is the what really matters is just continuously growing the results, growing the adoption of the stablecoin, growing the ability to generate net surplus, both for Sky and for the Sky agents, and have the Sky agents being able to innovate more, and that result in better economics. And then as long as that's the case, and as long as Sky is like the absolute leader on this front of really pushing the limit of what is possible to do with the fundamental value creation of blockchain technology, then there are going to be sophisticated investors, sophisticated buyers, and market participants that see the value and that patiently will tap into that opportunity. And the best example that we have of this, I think, is the Stablecoin Development Corporation, which was this recently unveiled public company that specializes in supporting stablecoins, and particularly has been accumulating a lot of Sky tokens. And the Sky Frontier Foundation was also a part of funding Stablecoin Development Corp, or SDEV, although this was purely a cash transaction. So Sky Frontier Foundation funded SDEV with cash and not with an injection of Sky tokens or something like that, which was seen with some other public companies in the past. But in this case, this is actually I would say more sort of pure construction that is just entirely focused on patiently and intelligently taking exposure to the value that exists in Sky and the general potential of the stablecoin space, and especially decentralized yield generating stablecoin projects like Sky.
When you think about, and I guess when investors also think about the difference between something like Sky or the difference between Circle or Tether and Sky, how does Sky differentiate from the field of the existing incumbents, being the number 3 now? How does it plan to kind of compete and juxtapose itself?
So fundamentally, Sky is just completely different. I mean, there isn't actually competition, I would say, and it actually ties back to sort of the earlier point, like things like regulation and fundamental positioning and the ability to access stable coins and things like DeFi yields. While I would say centralized stable coins like USDC and USDT, in some sense, in some sense, they're like a service almost, right? And there's like a company providing that service, while Sky is a technology essentially operated as an infrastructure that anybody can access and that can synergize with things like USDC and USDT, and actually does that. So Sky like works very closely with both USDC and USDT. I mean, the really big thing that, of course, is the kind of the killer app of Sky is the ability to use the decentralized stablecoin USDS to access a native yield generating technical system, basically, which is the Sky savings rate, right? Which is used by billions of dollars, institutions, sophisticated crypto users, regular people all over the world, right? And that anybody can access because it fundamentally just lives on the blockchain as an application that you can access through technological means. I think actually I would basically expect that over time you'll actually see companies like Circle and Tether that fundamentally are about providing access to solutions and services and sort of a user experience and a customer relationship related to DeFi and crypto opportunities. They might even be looking into how to expose something like the Sky savings rate, which is this very proven, clear track record, clear product market fit, and something that can be provided in a way that fundamentally complements what they offer without directly being like a service offered from a particular entity, but rather is accessed through a piece of technology.
That makes total sense. I think with the next leg of growth being really around kind of the Sky Asian network, and I guess specifically OBEX and cohort 1, I guess, and this is more of a probably something that I can take in terms of just like what does that first cohort look like, and maybe what does the pipeline look like for cohort 2. We first collaborated on OBEX with the idea that we really need to kind of own end-to-end the origination pipeline of credit for safety reasons mostly, because like as people are now finding out with these business development corporations in the U.S. and the private credit snafus, the sausage is made in such a way that it's kind of hard to tell what's in it, and if you eat too much of it, you could get really sick. And so like I think for us, we initially started to think about OBEX in terms of the pipeline through which we could vet teams, have them get familiar with the ecosystem, introduce them to the Sky Frontier Foundation, the risk team, and just kind of like onboard them into the protocol. And there's obviously going to be other ways to kind of interact with Sky, but that was the first real kind of realization that we had. And then I think from there, we also had this additional realization, which was instead of incubating from 0 to 1, and we are doing some of that, and River is going to be the first one that people hear about on that front. There are a lot of other teams that are stood up with the right rail, stood up with the right risk analysis, stood up with the right origination of credit flow, that it would be really smart to just kind of take them and reposition them into the ecosystem versus incubating a competitor to them. Like in the case of like a USDAI, these guys are going to every chip conference in the world, sourcing deal flow, getting familiar with GPU lending, doing it in an excellent way, that it didn't make sense to kind of have a competitor against them. And so you are going to see more familiar faces within this program, people like Securitize as well. But we're also going to try to do things from an incubation standpoint that add value to the ecosystem, that are net new teams that we're putting together. And so this program is based in San Francisco. We're leaning heavily on the US to do a lot of the team formation, capital formation around these different types of protocols. And a lot of the work that's going on in the background right now is just trying to do things smart from a risk perspective, getting a coherent risk model together, getting a good model of how much first loss capital we should put forward, getting a good idea of how the legal structuring and claims would work in any sort of bad credit event. And I think one thing that Rune and the rest of the Sky Frontier Foundation have never compromised on is just like, we're going to do things slowly and safe, and we're going to kind of not do them any other way until the system is fully ready. And I really expect OBEX to kind of get ready to get these products started to spin out. We're doing a trial in the next few months, and then I think towards the second half of this year is when you'll really see things start to pick up. And once we know how to do it with 1 or 2 of these teams, the hope is that the velocity will increase, and the only limiting factor will be, are there really good teams that are willing to buy into the Sky ecosystem, work at our pace, on our terms, and help us build something really special in terms of credit for the ecosystem. And so that is kind of the overall strategic intent, but just more diversified collateral base, more strategically important financing verticals that we're a part of, and more institutionalization as well is probably the goal of the protocol. And OBEX is already on its way, and we're looking good here. That was a question to myself, so maybe I'll ask the next one to you. So SDEV, Stablecoin Development Corporation, us, Sky Frontier Foundation, and Tether, participated in funding this. And there's more kind of Tether news probably to announce, not on this call, but in subsequent weeks. SDEV has accumulated about 9.15%, about 2 billion tokens of Sky. Talking to their management, what they've said publicly, they view Sky as an incredible asset because of the upside reflexivity, but also the yield and the pass back of economics that allows a public company to really subsist on a protocol in a way that has not happened before. I mean, just how does the Sky team view the role of a public company like this? Is this a template for others that is being actively pursued? How do you think about this?
Yeah, I think it's super exciting. I think, as we were talking about earlier, there's this disconnect in, you have Sky with very attractive financials, low PE ratio, all this stuff that makes it an interesting asset. But the types of people who tend to value assets based on their financials and their cash flows and so on, they're typically more traditional investors, and it can just be more difficult and potentially like there could be security issues and just all sorts of friction related to having direct exposure to crypto. But the fact that we're then still seeing such an interest from the traditional financial markets in getting exposure to Sky and being involved with Sky, that it actually made the case and resulted in the creation of SDEV is just very encouraging, right? And I think it's exactly the right way to do it. To be honest, over time, like the more I've worked in crypto, the more I realize it's just definitely not something for normal people. It's for like very advanced, very sophisticated users. And I actually believe that companies providing exposure to crypto is a very, I mean, and not just exposure, but things like governance participation, ecosystem participation, right? Like contributing to the development, to the safeguarding, to the protection of the ecosystem. This is all something that SDEV will be able to provide in various shapes and forms as it continues to expand its presence in the ecosystem. And I think for a lot of people, that's a very good way for them to participate, right? Instead of having to sort of figure out for themselves how to do all this, they can actually just take a stake in SDEV and then through that be fully covered. And I think especially, that's something that has caught the attention of TradFi players that otherwise wouldn't be, it might be a little bit too much to get directly involved with Sky right away. But with this, they have something that's actually ready right now that has a large percentage of the total supply of the token, and that has this bridge between two worlds of both understanding how to think in DeFi terms, but also how to think and how to communicate with TradFi.
And totally agree with that. I think the learning from SDEV from our front is that we have to meet people where they are, not try to drag them onto Coinbase or some other venue that puts their career at risk. They'd rather just buy the equity, even if it's kind of not the perfect one-for-one representation. And we are working to get it to that place, and there will be more announcements on that front in terms of the development of that company. But we are super, super excited for that team and that strategy to play out. And I think a lot of people think of this as a DAT. It is not a DAT. There are other concepts of public companies holding tokens that are building businesses around them. And that is ultimately what the Stablecoin Development Holding Corporation is just a way to get exposure to Sky in a regulated way. Maybe to close it out, Sky Frontier Foundation maintained its 2026 outlook, unchanged after Q1 record performance. That's amazing. What does that outlook entail? Where are you most focused for the rest of the year? And kind of any other broader closing comments to wrap up the call?
Yeah, I think, there was steady growth over the course of Q1. So ultimately the projections, they were all on track, as you saw earlier. And I think generally there's things like new Sky Agent launches and just a lot of product development and product adoption that I think will continue to drive growth and adoption of the ecosystem. Of these things, I would highlight that I think really will have a big impact on the projection, and that will sort of result in whether the original projection will hold or should it be adjusted upwards, should it be adjusted downwards. This all comes back to the launch of the Sky Agents and the performance of the Sky Agents. One thing is just like generally their ability to execute and ability to find new efficiencies and improve the overall network effect, economics, and growth of the ecosystem. But then also the sort of direct connection where whenever a new Sky Agent launches its token, that token then immediately becomes available as token rewards on the USDS stablecoin, which is a major driver of gross and net revenue to Sky. So the timing of those and the rollout of those and the success of these Sky Agent launches will have a big impact on what happens with the financials next. And of course, in the Sky Frontier Foundation, we're just continuously monitoring and tracking all this. It's all sort of happening. It's all happening live, right? All these are independent teams and they're collaborating together, but ultimately there's a lot of factors that impacts how everything plays out. And the Sky Frontier Foundation will continue to update and revise the model based on what's actually seen in reality over the course of the coming quarters.
Amazing. Well, this is, again, so proud that the Frontier Foundation has put this together and super excited to see what's next. And with that, I think we can close out the call. Thank you for everybody who has watched. Thank you, Rune, for leading this. And we will do this all over in Q2. And yeah, that's great. Thank you.
Thank you.